Today's featured guest, economist Harry S. Dent Jr. Harry S. Dent Jr., editor of the free newsletter Survive and Prosper. H.S. Dent Forecast newsletter offers current analysis of economic, financial, and market trends. Also author of several bestsellers. So it's a pleasure to have him back here on the show. Welcome back, Harry S. Dent Jr.
Nice to be back, Chris.
Investors weren't terribly pleased with the FOMC's decision to hold rates steady, although most of us had anticipated it. They had been talking about at least a quarter-point rate hike at the recent meeting, and now if we look at the implied volatilities in the 30-day Fed funds futures rate, we're not going to have a rate hike at the end of October either. Are they trying to manage, micromanage or macro-manage, I guess it is, China, the economic slowdown over there and in Europe? Are they concerned that there might be a contagion into the domestic economy?
Yeah, Chris, I've been saying the whole year that they would not raise rates this year. They intend to because it'd be the right thing to do, but, we keep seeing weakness around the world. I've been forecasting for years now that commodity prices are collapsing because of the slowing of China. This hits emerging markets, and it's hitting the whole kind of global growth and trade picture, and that's why they didn't move. Now, the Fed keeps saying, we're just looking at the U.S., we don't, manage the world. Oh, no, they balked because of weakness overseas. And again, I don't see a raise in December because I think the stock market's going to be lower in the next couple of weeks, and that's going to give them more cause to be cautious.
We've had nothing but a sell-off since the FOMC meeting, downtrend that we've seen following the first hour after the meeting. It's been nothing but down since then. So obviously, it's not what people were expecting. I mean, frankly, the Fed were very confident if the recession was over and our fears, regarding an economic pullback or downturn had passed, that they would certainly pull the trigger on rates because of fears of inflation. And they didn't do that, and they're not going to do it in October. 91% confident of that, even more so than the last meeting. Do you think they really are trapped here? I mean, as many of our guests have said, and they're just not going to be able to pull the trigger on rates at all?
Yeah, I think they are trapped. They're not getting... Another reason they didn't raise rates is that inflation has not come up to their 2% targets. Inflation just keeps not happening because of the broader deflationary trends after the greatest debt bubble in history. And debt bubbles are always followed by deflation. And frankly, that's one of the reasons gold keeps trying to rally, and it should rally here. Gold likes to see inflation. And until we see some inflation, the Fed's not going to raise rates, and we're not going to see this kind of rally in gold and other things that people expect, including me. So it's very unusual here what's happening, but it's because there's a broader deflationary environment. That's why the Fed and the central banks around the world have been printing money nonstop since 2008 because they're fighting deflation with inflation, and they're not succeeding. They can't get, even Japan can't get inflation to come up with 3 times the stimulus we had. So it's very unusual. People need to understand that deflation is the trend.
But I think it's important because these themes, these trends are central to, making wise investment choices and positioning one's portfolio, in the best and most profitable direction on a forward basis. And it really caught almost every money manager off guard. They all get on this risk-off trade, the long-only trade. I mean, even hedge funds, which the prime directive, if you will, was to get rid of risk, to hedge away risk. And they didn't. They said, I'm going to keep up with my colleagues. And so everybody gets heavy on one side of the trade. You're not convinced that trend is going to continue. You think we could see more pain in the equities markets?
Oh, yeah, Chris, I see this as the first wave down of 3 major crashes that are going to happen over the next year and a half or so. And I think this wave down is not finished. We're bouncing a little bit off the last little mini crash, but I think we're going to go down into mid-October, somewhere between 14,000 and 15,000 on the Dow, roughly. So another mini crash, and then we'll probably rally into year-end. But that'll just be the first wave down, 20% or so in stocks. And then we'll see, I think, the biggest wave down in the first half of 2016, and then a final wave down into late 2016, early 2017. Most crashes happen that way. There's three major waves down and then bounces in between. And the bounces can be strong. So the good news for people that have been caught in this and said, oh, I didn't think the stock market could go this far down. Well, wait for the next bounce, maybe into November or December. It could be substantial. And then bounces in the market in stocks is a way to get out, because stocks are going to get hit the hardest here because they are the ultimate risk-on trade that is going to fail after the greatest bubble in history.
I just want to qualify here, bigger believer in reducing exposure, but not completely eliminating any asset class from the portfolio, because in the final analysis, very few people know exactly what's going to happen, and timing the market is not something I want to promote too strongly. But I do want to keep up with an important theme you've covered in the past, the commodities market. And dollar strength continues for the most part. It's taken a pause here over the last several months. Do you see further pain ahead in commodities? And also we'd like your views on black gold.
Commodities, by our thing, it's a very clear 30-year cycle. We've been warning for years that commodities were going to peak, and people keep telling me, Harry, you don't know about the growing middle class in the emerging world. I said, look, I understand that, but the emerging world gets hit harder when we go down, the developed world. And China has been slowing, and they've been the biggest consumer of commodities. So commodities are going down, and we don't see this cycle bottoming until like the early 2020s. That's many years from now, although I think we've seen the worst of it. I mean, iron ore is down over 70%, and coal and oil and all these things. I see oil going to $10 to $20 a barrel before it bottoms, and I think we're going to see 30 to 32 in the months ahead. But ultimately, $10 to $20 a barrel. It's not going to stay there. That's just going to be a bottom. But I see oil in the kind of $20 to $60 range for the next several years, and so that's going to kill all these frackers and the tar sands producers in Canada. And that's exactly what Saudi Arabia wants. They're the low-cost producer at $7 a barrel. We're 55 to 80 here with the frackers, and everybody thought the fracking thing was a revolution, was going to make U.S. independent of oil and all this sort of stuff. It was just a bubble. It only happened because junk bond rates went down to 5 to 6%. Now they're at 8. Next thing you know, they're going to be 10, 15, 20%. And oil prices shot from $32 to $115 just because of global stimulus by central banks.
That's interesting, because that would just decimate the upper Midwest.
And Texas, the strongest state in the country. People don't realize that Texas had a recession and a real estate crash in the early to mid-'80s because oil dropped, like 70%.
Keep in mind, they also used incredible derivatives in that housing boom there. And I think they learned their lesson. For instance, Houston didn't suffer during the recent housing crash, one of the few major cities to walk away unscathed. But yeah, your point is well made, because the fracking business carried the whole middle section of the economy there through the last 6-7 years. Move on to another important part of the financial puzzle, and that's the housing market. The echo boom, quite a remarkable rebound. If we look at it just statistically or on a chart, certainly had a 50% retracement from peak to trough. Nevertheless, we're starting to see some cracks in the foundations. More specifically, it seems like almost every important component, anything that could really sustain the market for the long haul, is starting to get a bit thin. For instance, the Fed is obviously going to stop at some point holding rates low. At least that seems to be their mandate. Plus, we're seeing considerably lower disposable income for the median home here. It's about $5,000 or $6,000 less than in 2007, 2008. And there's one other interesting aspect. From a technical perspective, there is a massive diamond in the Philadelphia HGX housing market. This preceded the recent crash in the S&P 500. Give us an idea of what you see in housing.
Yeah, from my view, housing started a major long-term downturn after the baby boomers were done buying, which is a predictable thing, and the younger generation cannot get loans easily, do not have the same job prospects, and have student loans. So housing started to go down, but the Fed interrupted it with QE 1, 2, 3 plus. So I think housing has bounced back. It's not to new highs in most areas. It's going to go down lower than before in the next several years. So housing, real estate, I think, is going to go back down at least to where the bubble started in January of 2000, and that is 50% lower on average and way lower in some areas like Miami or San Francisco or Manhattan. And everybody thinks you can't lose money buying a $20 million condo.
You've given us a pretty solid overview. I mean, you haven't really been too specific on gold, but obviously you don't see inflation without inflation, expecting deflation still. Interestingly, as we mentioned, Jim Rogers agrees with you. He thinks the dollar will remain strong despite everyone's contention to the opposite, and he thinks that once that peaks out, that's when he's going all in on the precious metals again in the next few years. Any other comments? I mean, for instance, do you think maybe the gold mining sector, the selling there is overdone? It's certainly been a favorite theme recently.
Well, there's no question that gold and gold miners are oversold, and they're due for a bounce. But I think the bounce may be more back to 1,200 or something on gold, and then it goes down because of the deflation trade. And I agree with Jim Rogers. I'm bullish on the U.S. dollar, but I'm only bullish into around early to mid 2017. I think once the dollar catches up with other currencies, it's been down since 1985, then I would be neutral or slightly bearish on the dollar. So this dollar rally is not going to last forever, but it is going to continue to hit commodities on top of the slowing of China and the emerging world because of commodities collapsing. And China, people say China's growing at 7%. There's no way that they could be growing at 7%. Their statistics are inflated. I think China's growing more at 3.5% to 4%, and they're going to go into the deepest recession we've ever seen in the world. So commodities are going to get hit by China more than anything else. And so you have to wait for the China crash to happen and then reevaluate. And I think when that happens, the dollar will go up as the safe haven in the world. But after that, I'm not bullish long-term on the U.S. dollar because we'll never be what we were in the past decades. But we are the safe haven in this downturn, and I do think the worst of the downturn is going to happen in the next year and a half or two. And so I'll reevaluate gold and the U.S. dollar maybe a year and a half, 2 years from now. But for now, it looks like gold is more down after a rally. It still deserves a rally here. I would use a rally in gold to get out, but when gold does finally go down and find its bottom, in the long term, we're going to have the biggest commodities boom in history for decades to follow because the emerging world is going to generate all the growth, and they are commodity and gold intensive. Indians and Chinese buy more gold than anybody.
So let's talk about, as we wrap up here, the BRICS nations and the potential energy that you see there. Continued sluggishness in China, which has sort of been poised to surpass the United States as the world's largest economy. I'd like to hear your demographic assessment of China.
Well, China is the only emerging country. It's the largest next to India, which is going to surpass them in population down the road, but the only emerging country that has a declining workforce since 2012, and it's going to decline for decades ahead. So they're growing on urbanization, and the government is force-feeding it at its steroid rates, and that's why they've overexpanded. They just opened the biggest steel plant ever when they're already 40% over capacity in steel. They're building stuff for nobody. Condos, roads, malls, offices, infrastructures, railways. So China's already expanded enough for their growth for the next decade.
China tends to be ahead of the curve, and so why are their policymakers making this mistake from your perspective?
Because they want to grow. They want to grow, and it's all through a top-down system of communist governments who basically guarantee loans for the smaller local governments, and they give all their contracts to their crony partners in business to build stuff for nobody. China is building infinite stuff for nobody. If a business did that, they would be bankrupt by now. And when you overbuild, what do you get? Deflation, because you've got too much capacity, prices fall to clear the capacity. For the next decade, it's the worst place to be, worst place to put your money. India is going to grow because they're the real deal. They are not as urbanized. They have much better demographics for decades ahead. And when China fails, foreign investors are going to say, oh, what's the next big thing? It's India with 1.4 billion people. They're about equal with China today. They're going to be larger in the future. India is the country of the future, and they're going to decline in the future. China's going to actually decline in population.
A similar playbook as Japan, 80s and 90s. That's once again, this growth pattern seems to continue westward. Go west, California to Japan, Japan to China, and now China to India.
Yeah, Southeast Asia and India are the next growth arenas of the world. So when we do have this crash that I'm forecasting, that's going to be very substantial and last for another 2 to 5 years or so, I want to invest in Southeast in South Asia. That's where everything's going. China's already seen most of their boom, and they've overbuilt. They still have urbanization for a couple of decades, but they've already overbuilt for that. They could never build another condo in China and house all the people coming from rural areas for a decade or two. They have 240 million people in cities that are not even registered people in those cities. They're like illegal immigrants in the United States. They don't have access to health care or education or any of the minimal welfare things there. They are trapped. They have no skills. They've just come off the rice paddies, and they can't even move back to the rice paddies because they paved them over with condos that are empty. The huge potential unrest.
A lot to digest, a lot on the plate. Please tell people more about the services you provide, how they can get in touch with you.
Yeah, the best thing, we have a free daily newsletter that keeps people in touch with what we're thinking. It's at harrydent.com. It's that simple. Go to harrydent.com, put in your email, you're on our newsletter, and we'll keep you updated because we think there are major changes coming in the next few years, major threats and major opportunities.
Thank you. Have a great remainder of the day.
Okay, thanks, Chris.